Hi class. In this lecture video, what we want to talk about is something called annuities, methods of savings and investments. So the method of savings and investments, we'll kind of talk about like the stock market a little bit. There's not too many really intense computations we have to do for those sections. However, for annuities, there's going to be a lot of calculator work. So as you go through this lecture, I encourage you to keep your calculator handy and follow along with me as I do these problems as well. Okay. So first off, our objectives in this section, we want to determine the value of an annuity. We want to determine regular annuity payments needed to achieve some type of financial goal. All right, those will be the two really complicated calculations and formulas we'll need. Then we want to understand what stocks and bonds are as investments. We want to read stock tables, and then we want to understand finally accounts designed for retirement savings. All right, so I've been talking about annuity, and it's a little bit complicated. So what exactly is an annuity? Annuity is a sequence of equal payments made at equal time periods. Okay, so there's two types of annuities. You can pay into annuities, and then you can get paid out from an annuities. We're going to talk a little bit about paying into annuities. So then the value of an annuity is the sum of all the deposits that you put into an annuity plus all the interest paid. Okay, so let's do some examples here. So let's just talk about determining the value of an annuity. So suppose you deposit $1,000 into a savings plan at the end of each year for 3 years. Okay, so the interest rate here is 8% per year compounded annually. All right, so every year for 3 years, I'm gonna put $1,000 in and I get this compound interest of 8%. So I want to find the value of the annuity after 3 years, and then B, I want to find the interest. All right, so the solution, remember the first thing is the value of the annuity is the sum of all the payments plus the interest. So the value of the annuity after 3 years is the sum of all the deposits made plus all the interest paid over 3 years. Okay, so the value at the end of year one, okay, because you're going to deposit the money at the end of the year. So at the end of year one, you're going to deposit $1,000. Now you don't get any interest on that $1,000 because you made it at the end of the year. So the value at the second year, all right, you get the $1,000 that you deposited, plus you get the 8% interest on it, plus you're going to deposit another $1,000. So 8% on your 1,000, that after year one was worth $1,080. And then at the end of the year, you deposited another 1,000. So your annuity right now has $2,080. Well, then as you go to year three, so year three, you take that $2,080 and you get another 8% interest on it. And then you're going to deposit another $1,000 over here. So this times the 1.08 gives you this much money, plus the $1,000 you put at the end of the year. So the value of this annuity, when you sum those up, is $3,246.40. Okay, so how much money did you make in interest then? Well, you made three payments of $1,000 each, depositing a total of $3,000. So the value of the annuity we saw was this 3246.40. So the interest is, we'll subtract away the deposits that you made. So your annuity made $246.40 in interest. All right, so now we have a formula for this, okay? So the value of an annuity, all right, and this is when you do interest compounded just once a year. So interest is just compounded annually. So if P is the deposit made at the end of each year, right, for an annuity that pays an annual interest rate R, and I'm going to change it to decimal form, okay, compounded once a year, the value A of the annuity after T years is given by the following formula. So P is the principal. So you take your principal and you multiply it by 1 plus R raised to the T power. Okay, so T is the number of years, all right, that you're going to have the annuity. You're going to subtract away 1, and then you're going to divide that by whatever the rate was R. All right, and so this gives you the value of the annuity after, say, like 5, 10 years, something like that. So for however long you're going to have it in there. So if it's compounded just once a year, you're going to need three things to solve. You're going to need P, the principal, the rate, and the number of years, T. All right, so let's do an example. All right, and as we do this example, keep this formula handy. So as you have these note sheets printed out, keep this handy. All right, so to save a retirement, you decide to deposit $1,000 into an IRA account, which is an independent retirement account. at the end of each year for the next 30 years, okay? So if you can count on an interest rate of 10% per year compounded annually, right? How much money will you have from the IRA after 30 years? Let's find the interest. Okay, so remember, you're going to need three things. The principal, I'm depositing 1,000. The rate, which is 10%, and then you're going to need the T, which is 30 years. So you're going to take those things and plug it into your calculator. All right, so you can see the math here. I have it worked out. So what I want to do is I want to show you how to do this in your calculator. So have that handy with you. Okay. So the amount of the annuity is equal to, all right, so the crazy thing here is when you go to do this by hand, you're going to want to do this piecemeal. Okay, you can plug this in your calculator all in one step, but it's totally up to you. All right, so I'll show you how to do it piecemeal, and then I'll show you how to do it all in one step. So the first thing, order of operations, you're going to start way in the inside of the parentheses. 1 plus 0.10, enter. Now you're going to raise that to the 30th power. Now you're going to subtract 1. Now you're going to multiply that by 1,000. And now you're going to divide that by whatever the rate was. And look, $164,494. And here I have knocked off the 2 cents. Or, all right, let me show you how to do this all in just one step on your calculator. All right, so you go 1,000 times first set of parentheses, a second set of parentheses, 1 plus 0.10. Close the second set of parentheses. Raise that to the 30th power. Subtract 1. Close the parentheses. And then divide that by the rate. You'll get the same thing. So it just involves practicing with your calculator here. You know, like you'll get better with the calculator the more you practice it. And if you're struggling with any of the calculator work, you're more than welcome to come and ask me for help. All right, but all we did, sorry, go back, was you take the principal, the rate, the number of years, and the rate, and just plugged it in. Okay, so after 30 years, all right, you will have $164,494 in your IRA account. Pretty good. All right, well, how much of that is interest? Well, you made 30 payments of $1,000 each, so 30 times 1,000 is $30,000. But because this is how much the annuity is worth, the interest you made, look at this. You take that $164,494 and you subtract $30,000. You made $134,494 in interest. So this interest is nearly 4.5 times the amount of your payments. So you're going to want to invest your money early so you can keep making these type of payments in the long run. All right, that's good. So just follow the formula. Follow the formula. Okay, so now you know that was only compounded annually. So what happens if the interest is compounded n times per year? Okay, so if P is the deposit made at the end of each compounding period, so how much you're going to put in each period, okay? For annuity that pays an annual interest rate of R, so R is the rate, compounded n times per year, so n is like if it's monthly, n will be 12. If it's bi-yearly, n will be 2, so on. All right, the value A of the annuity, all right, after T years is given by this crazy formula. So the principal times, and then in parentheses, 1 plus R divided by N, and then you're going to raise that to the N times T power minus 1 divided by R divided by N. Okay, same crazy thing here. All right, let's work an example. So at age 25, all right, so you want to start savings for retirement. You decide to deposit $200 into an IRA at the end of each month. Okay, so that's telling you each month, so that's 12 months a year, at an interest rate of 7.5% per year compounded monthly. So how much will you have in the IRA when you retire at age 65? And let's find the interest. Okay, so here's the thing. Principal, P, That's the $200 you're going to deposit. Sorry. Rate is 7.5%. The number of times you're going to compound it per year, well, you're going to do it monthly, so that's 12. In T, the number of years you're going to have it in your account, well, if you start at 25, retire at 65, you're going to do it for 40 years. So just like this, you're going to have to take this, all right, and plug this into your calculator. So let me show you how to do that again. So the amount is equal to the principal. So I'm going to show you how to do this all in one step. It'll be crazy. 200 times big set of parentheses. Now let's do a little set of parentheses. 1 plus the rate 0.075 divided by 12. Right? Close that set of parentheses. Now raise it. Now in this calculator, to do the 12 monthly payments times the 40 years, you have to put this in parentheses, 12 times 40. I'm going to close that parentheses. Now I need to do minus 1. Now I need to close the outside set of parentheses. And then I need to divide that by, now to do this part, the rate divided by the number of times per year, you're going to have to put that in parentheses. 0.075 divided by 12. Close the parentheses. And look. $604,764, and I'm just going to round it up to the nearest dollar here. We'll always round up for these cases. Get 65. That's crazy. So you can do this, one step at a time if you want to. Like, let me show you. You could do in here 1 plus 0.075 divided by 12. I'm going to raise that to the 12 times 40th power. Close that parentheses. I'm going to subtract 1. I'm going to multiply that by 200. Now I'm going to divide that by, and then in parentheses, 0.075 divided by 12. You get the same thing. So whatever way is easier for you, okay, you're more than welcome to do that. All right, so how much did you make in interest? Well, that's the value of the IRA, which we found, times the total deposit. Remember, you're going to do 200 deposits times 12 months per year times 40 years. So 200 times 12 times 40, you put $96,000 into the IRA. And if you subtract that from the total value, wow, the interest you made is approximately $508,765. So that's more than 5 times the amount of your contribution. So the power of interest here is important, right? When it's compounding, you're making a ton of money on the interest here. Okay, let's change this up a little bit now. Suppose you have some future goal, right? And in this future goal, you want to figure out, all right, I want to have this much money, right, at the end of N years, okay, or at the end of T years. So I want to figure out how much I have to put away to meet that goal. So the deposit P that must be made at the end of each compounding period into an annuity that pays an annual interest rate of R, okay, in decimal form, compounded N times per year, in order to achieve a value of $8 after T years, is given by this formula. Okay, so P is going to be the amount I have to deposit is equal to the amount of the value of the annuity I want it to have. Like if I want it to be $1 million or $20,000, whatever. Okay, so the amount of the annuity A times R divided by N, whatever that comes out to be, divided by, then in parentheses here, 1 plus R divided by N raised to the N times T power minus 1. Okay, so again, you're just going to need 4 things here. You're going to need to know the amount you want the annuity to be valued. You need to know the rate. You need to know the number of times you're going to compound per year. And you need to know T, the number of years, right, that you want to meet this at, have this goal go to. Okay, let's work an example. Suppose that once you complete your college education, begin working, you'd like to save $20,000 over 5 years. Okay, so listen, that's the amount you want to save. That's the A. and I'm telling you the T, the 5 years, right? You want to use this as a down payment for a home, right? You anticipate making regular end of month deposits into an annuity. So I'm going to, at the end of every month, deposit. So the N is is 12, okay? 12 times per year. That pays 6% compounded monthly, okay? All right, so A, how much should you deposit each month? And how much of the $20,000 down payment comes from deposits and how much of it comes from interest? You know the rate, 6%. You know T is 5. You know A is 20,000. You know N is 12 because you're going to do it monthly. Boom. You know the 4 things. You just need to plug it into this formula. All right. So let me walk you through on the calculator here. How much do I need to deposit? The principal is equal to A, I want to have $20,000 times, now in parentheses, all right, the rate divided by N. Well, you're getting 6% divided by 12 for the 12 months of the year. That's 100. Now you need to divide it by this crazy thing. So divide it by, start the big set of parentheses, the small set, 1 plus 0.06 divided by 12. I close that parentheses. But I'm going to have to raise that, another set of parentheses, to the 12 times 5. Close that parentheses, minus 1. And then finally close the last set of parentheses. And you should get this, $286.65, which is approximately $287. All right, so what's going on here is you should deposit at the end of every month $287, all right, to be sure of having $20,000 for down payment in 5 years. All right, so the total deposits that you made were $287,000 times 12 deposits per year times 5 years. All right, you've made only $17,220. And then the interest, we'll subtract the $20,000 you're going to have, minus the $220,220, and you made $2,780 in interest towards this down payment on a house. So what you can see here is this is all just calculator work. Just you figure out the things you need, plug them into your calculator, and you go. All right, so let's talk now. Let's get away from some annuities and start talking about investments of some type. So when depositing money into a bank account, you are making what's called a cash investment. All right. The account's interest rate guarantees you a certain percent increase in your investments. This is called its return. Now the thing is, the return or the interest rate savings accounts give you in like a bank account are like really terrible. Right? They're really close to zero. All right. You know, so it's having a lot of cash on hand in a bank account isn't always a good thing. All right, so sometimes you want to get a bigger return. So other kinds of investments that are riskier, okay, are called stocks and bonds. Okay. So investors, what are stocks? Investors purchase stocks. This is shares of an ownership in a company. All right. So for example, if a company has issued a total of 1 million shares, right, and an investor owns 20,000 of those shares in the company, well, how much of the company does the investor own? Well, if you take his 20,000 shares divided by the 1 million total shares, you get 0.02, where this investor owns 2% of the company. So any investor who owns some percentage, okay, it can even be a fraction of a single percent, okay, it doesn't matter, of a company is called a shareholder. Like, let me give you an example. I own a couple stocks in Microsoft, so I am a shareholder in Microsoft company. I'm a part owner of Microsoft company, but I mean I'm like a 0.000000001% owner of it. Like I have very few shares. Okay, so buying or selling stocks is referred to as trading, and stocks are traded on the stock exchange. Like the closest one to us is the New York Stock Exchange. So there are 2 ways to make money investing in stocks. So one way is you can sell your shares for more money than you paid for them, in which case you have a capital gain on the sale of the stock. Like for example, suppose I bought my Microsoft shares for $50, okay, and now they're worth $120, and I go to sell that. Well, I paid 50, but I got 120 back for it, so I made $70 in capital gain on that stock. However, while you own a stock, the company distributes all or part of its profits to shareholders as what's called dividends. So, like if I own say Disney shares, okay, I don't know if they pay dividends or not, but suppose I own shares of Disney, okay. At the end of the year, Disney would be like, oh, we made $1 billion. We're going to pay out a certain amount of it to our shareholders. All right, that money is called dividends, just cash they give you. All right, so bonds, in order to raise money and dilute the ownership of current stockholders, companies sell bonds. So people who buy a bond are lending money to the company from which they buy the bond. Governments also sell bonds too. So bonds are a commitment from a company to pay the price an investor pays for the bond at the time it was purchased, called the face value, along with interest payments at a given rate. Okay, so you can buy a bond for $5,000 and you'll get $5,000 back plus some interest rate. That's what this is saying. A listing of all the investments that a person's hold is called a financial portfolio. And most financial advisors recommend a portfolio with a mixture of low risk and high risk investments. Right? This is called the diversified portfolio. You want to be diversified between low risk, low reward, and high risk, high reward investments. All right, so when you open up a newspaper, you can read stock tables. Okay, so like if you click on a daily newspaper and online services, they give current stock prices and other information about stocks. These are the following things they give. All right, 52-week high refers to the highest price at which a company traded during the past 52 weeks. 52-week low refers to the lowest price at which a company traded during the past 52 weeks. The stock refers to the company name, like Microsoft. The SYM, right, this refers to the symbol the company uses for trading, like General Electric, okay? Their stock is not, when you see the company name listed on the stock exchange, they're referred to as GE. That's the symbol they use for them, right? Google uses GOOG. DIV refers to dividends paid per share to stockholders last year. Not all companies have dividends. The YLD percent stands for the percent yield, all right? Vol 100s stands for the sales volumes in the hundreds. We'll go through an example of all this in a bit. High stands for the highest price at which the company stock traded yesterday, right, the day before. Low stands for the lowest price at which the company stock traded yesterday. Close stands for the price at which shares were traded when the stock exchange closed. And net change, net CHG stands for the net change. And PE stands for what's called the price to earnings ratio. All right, so PE ratio equals yesterday's closing price per share divided by the annual earnings per share. All right, so we're going to do an example of all these things. So we're going to use a stock table for the company Disney to answer the following questions. Okay, what were the high and low prices for the past 52 weeks? If you owned 3,000 shares of Disney stock last year, what dividend did you receive? What is the annual returns for dividends alone? Right? How does this compare to a bank account offering 3.5% interest rate? How many shares of Disney were traded yesterday? What were the high and low prices for the Disney shares yesterday? A little bit more. What was the price at which Disney shares traded when the stock exchange closed yesterday? What does this quotations ... in the net change column mean? And let's compute Disney's annual earnings per share. Okay, so their PE ratio. All right, so the annual earnings per share here is yesterday's closing price per share divided by that PE ratio I was talking about. All right, let's do all this. So here's the stock table for the Disney company. Okay. So as we go through these problems, have this handy with you. All right, so first one, say what were the high and lows of the 52-week? Well, 52-week high was $42.38. Okay. The 52-week low was $22.50. All right, so dividends. So remember, we own 3,000 shares. Okay, if we look under the heading div for the dividend paid for share for Disney stock, so the annual return of a share last year was, look at dividend is 0.21. So if you owned a single share, at the end of the year, they gave you 21 cents. That's what this is saying. So if you owned 3,000 shares, then you received a dividend of 3,000 times 0.21. They gave you a check, literally just for owning 3,000 shares. They gave you 6 shares. They gave you $630. All right, the heading yield is the percentage that give investors an annual return on their dividends. So for Disney, it's 0.6%. So this is the percent yield. This is much lower than a bank account offering 3.5% interest rate. Okay, so basically what this is saying is if your stock was not going to increase in price, you should have put that money just in a bank account. It should be noted that in the real world, a single bank account doesn't pay 3.5% interest rate. It doesn't do it. All right, D. So we look under values 100 for the number of Disney shares traded yesterday. All right, so Disney traded 115,900, but that's in terms of hundreds. So times that number by 100. The number of shares that were traded, so bought and sold, were 11,590,000 shares. Okay, crazy, but that's normal for a company like Disney. Let's just look at yesterday's high and low. So the high and low prices for Disney shares yesterday are found under high and low. Hence the high price yesterday went all the way up to $32.50. And the low price, it did fall all the way down to $31.25. Okay, so F. Let's just look back at what F was. F was, the price at which Disney share traded when the stock had closed yesterday. So close, when the stock closed at $32.50. All right, the ... under net change means there's no change in the price in Disney stock from the market closed 2 days ago to the market's yesterday closed. So that's all it means. It didn't change much. It didn't change at all over the last 2 days. Okay, so we want to find now the annual price per share. Okay, so that's just equal to yesterday's closing price divided by the PE ratio. Well, if you look here, yesterday's closing price was $32.50. They tell you what the PE ratio is. It's 43. So divide that, you get 0.76. So thus the annual earnings per share for Disney was 76 cents. All this is telling us, just to go back about the PE ratio, tells us that yesterday's closing price is 43 times the earnings per share. So what that means is if you took how much money Disney actually made in profit divided by the number of shares, that's going to be some number. But the closing price was actually 43 times that value. It's pretty high. All right, so let's just end talking about some retirement savings. Okay, so this is about stashing cash and making taxes less taxing here. So you can use regular savings and investment accounts to save for retirement. There are also a variety of accounts designed specifically for savings. So there's what's called a traditional individual retirement account, the IRA. So this is a savings plan that allows you to set aside money for retirement. So it's up to $5,500 per year for people under 50 and $6,500 per year for people 50 years and older. And you do not pay taxes on the money you deposit into the IRA. Okay, but you do, you can start withdrawing your money from your IRA when you're 59 and a half years old. And what you withdraw the money from is taxed. So the idea behind these is you deposit money when you have a high tax bracket, and you withdraw money when you retire and have a lower tax bracket. A Roth IRA is a type of IRA with slightly different tax benefits. So you pay taxes on the money when it's deposited into the IRA, but when you withdraw your earnings tax-free at 59 and a half years old. Although your contributions are not tax deductible, the earnings you make, are never taxed even after withdrawal. So that's really good. So employer-sponsored retirement plans, these include what are called 401k and 403b plans, are set up by the employer who often makes some contributions to the plan on your behalf. If you have a job and it has one of these, you should take advantage of this. And these plans are not offered by all employers, but are used to attract high-quality employees. So you'll want to, when you get your first real job after college, you'll want to get a job that has one of these retirement plans. All right, class, thanks.